Hi, everyone. This is Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. I wanted to come back to you today, continue to talk about the ongoing banking crisis with an important message, which is the too big to fail banks are not immune from deposit runs. So putting aside fraud or criminal activity, banks typically fail in one of two ways, either through insolvency or liquidity or both. Insolvency occurs when the bank doesn't have enough assets to cover its liabilities, whereas insolvency tends to emerge gradually. For example, when it develops from deteriorating kind of Main Street economic conditions. On the other hand, illiquidity leads to insolvency much more quickly. Illiquidity results when the bank doesn't have enough cash on hand to meet its customers' demand for it, and this can occur rapidly. Deposit runs are one of the main ways a bank can suddenly find itself in a liquidity crisis, which eventually spirals into insolvency. If many large depositors show up all at once demanding their money back, which was the case with Silicon Valley Bank and First Republic Bank, the bank, which only has a limited amount of cash on hand at any time, may be forced to sell other assets, such as investment securities or loans. Rushed and panic selling in a difficult market environment results in the bank being forced to sell assets for less than their book value or their intrinsic value. When this happens, the difference between book value and realized value results in a loss upon the sale, depleting the bank's capital. Eventually, the bank becomes undercapitalized, or even worse, in a deficit position, owing more than it owns. Regulators step in, and this is what turns a liquidity crisis into a solvency crisis. With differing details, this is what happened time and time again over the past couple of months, resulting in 3 of the 4 largest bank failures of all time. The banking liquidity crisis of 2008 sprang from different sources, but had the same net effect. Rather than losing depositors, the investment banks such as Bear Stearns, Lehman Brothers, Citigroup, and others lost access to wholesale funding lines, which, rather than being provided by businesses and customers, came from other banks, hedge funds, money market funds, insurance companies, and other non-bank financial institutions. But the results were the same. With liquidity drying up amidst the howling fear of those days, the banks were forced to sell assets on the cheap, creating this downward spiral. When wholesale funders got nervous, they pulled their lines, and this happened in a matter of hours and days, often in the form of overnight repo loans that would not renew. The surviving too big to fail investment banks such as Goldman Sachs, Morgan Stanley, and others were fast-tracked by the Fed and the other regulatory agencies to become deposit gathering institutions regulated by the Federal Reserve, which also gave them access to the Fed's discount window, where in an emergency, they could pledge as collateral quality assets in exchange for quick cash. And now they could also appeal to businesses and individuals for deposits. Now, these customer deposits often came in the form of broker deposits, in other words, not for the bank's own customers, but sold to them, or uninsured hot money, i.e. funds that may be withdrawn from the bank by its customers on demand. So whether in the form of wholesale funding lines or customer demand deposits, these now too big to fail banks face the same liquidity risks they did in 2008. That is to say, once fear and panic sets in, there is nothing that can keep these sources of funding from running for the hills. And this is the punchline. No bank can withstand a deposit run. If you take anything away from this video, it's this. No bank is safe from a deposit run once its wheels are fully in motion. Not even the too big to fail banks. Not even mighty JP Morgan. Deposit runs are often driven by irrational psychological phenomena, the so-called madness of crowds, not facts or figures concerning the underlying financial condition of the bank. Nevertheless, they create self-fulfilling prophecies by setting in motion the spiral of liquidity that then turns into solvency issues. Perversely, it is the biggest too big to fail and the regional banks that may be most at risk. As public companies, details of their financial results are interrogated by investors every quarter. Every snippet of negative news in an SEC filing or press release raises the question, what does it mean? Is there something wrong? All banks of any size are required to make weekly regulatory filings that are publicly available to any intrepid analyst or researcher willing to dig. Yet the too big to fail banks and the regional banks, by virtue of size and importance, are more visible and much more heavily scrutinized. This means that they're also more exposed to the momentum of investment blogs, social media, and in real life social networks. So why did Silicon Valley Bank fail when it did? Not because it was insolvent, or at least initially illiquid, but because SVB's venture capital customers heard, fueled, and circulated rumors that there was a liquidity problem at the bank. and an example of a manifestation or prophetic utterance. So it was. And the same was true for First Republic. In the absence of swirling rumors, which led to short sellers and depositors alike targeting the bank, First Republic likely would have lived to fight another day. And this is the point. When the all-seeing eye of the market decides, for whatever reason, rational or not, to turn its focus to the next one or several of the too big to fail or regional banks that have underlying issues and challenges, what stands in the way of the next massive bank failure? In this scenario, the FDIC would be all but useless. Its 128 billion deposit insurance fund is less than 10% of total deposits. It's already absorbed some 35 billion in projected losses from the recent bank failures. Really, only the Federal Reserve's discount window and emergency funding lines would make a meaningful difference. But if the Fed starts to buy assets again, inflationary forces would regain the upper hand, erasing the moderation in price levels that we've seen in the last few months. So the Fed's balance sheet is already over 8 billion, which is up tenfold since the global financial crisis in 2008 that we're talking about, while total banking system deposits are up to over 17 billion, and they grew dramatically during pandemic relief and lockdowns in that whole period of time when there was so much money floating around. One institutions, JP Morgan Chase, now holds 1 in 10 of every dollar of deposits that are out there in the system, increasing all the more following the acquisition of the assets of First Republic. So there's been a lot of talk recently about the small community banks being at elevated risk due to higher exposure to problems from commercial real estate markets. This is true, but perhaps the real risk lies elsewhere with those same too big to fail and regional banks that are clearly in the spotlight and subject to the vagaries of market sentiment and an investor psychology that is tilting towards fear and panic. On the other hand, by their very name, the smaller community banks benefit from intangible benefits and loyalties and local alliances that the bigger banks, often more anonymous, faceless, amorphous, they don't really have. The community banks are usually privately held by local shareholders or in forms of mutuals or trusts or otherwise, which same entities are often the core depositors. This may actually prove to be the safer harbor in the banking storm, which has yet to fully pass. Anyhow, I hope you found this helpful. If so, give it a like, share it, and subscribe to my channel here on YouTube, and sign up for weekly updates at stormwall.com. Thanks for spending time with me, and we'll be back soon with more on the emerging and evolving banking crisis.